Welcome to our review session for exam number 2 for the 16th edition, and this is managerial accounting. This exam covers chapters 19, 20, and 21. I apologize, for some reason I have the exercises all out of order. I'm going to go through them today, each one, and I'm going to do them in the order by chapter. So I will be jumping around a little bit. Again, I apologize for the way I've set up this set of practice exercises. So as we get started, I'll just remind you that in order to find these practice exercises, you need to change to the tab that says assignments I can practice now or all assignments. It doesn't show up on the default tab, which is assignments I can take now, because it's not graded. You can do this practice set as many times as you desire. Each time you start, it should give you the same exercises, but with different numbers, so you could keep practicing if you wanted to do that. I also want to remind you about one piece of information in the reference materials folder in Brightspace, and this is for chapter 20. There is a page called Useful Formulas for CVP Analysis, and you can see that on your screen right now. For the chapter 20 exercises, I'll be referring to the formula that's here in the middle of the screen to find number of units. That can be used both for break-even units and for a targeted level of profit. And the explanation for where that formula comes from is right here in the chapter 20 folder. So we'll start with the first exercise in the set. This is from chapter 19. You can see we'll do exercises 1 and 2, and then we're going to jump down to exercise 11 through 14 to make sure that we're doing them chapter by chapter. So this is the support department cost allocation using the sequential method. Back Mountain Sports Incorporated produces skiing and snowboarding gear. The company's main production departments are molding and finishing. Production of the skiing and snowboarding gear cannot be accomplished without the supporting tasks of materials management and meals for production employees provided by the cafeteria. Cafeteria costs are always higher than materials management costs. The company believes that the number of employees in each department is the best driver of cafeteria costs. The number of employees in each department is as follows. The company also believes that the value of support materials used in each department is the best driver for materials management costs. The support materials used in the molding and finishing departments are valued at $1,900 and $3,100 respectively. Using the sequential method for the support department cost allocation, allocating cafeteria costs first, determine the percentage of cafeteria costs that should be allocated to the molding department, and then the percentage of materials management costs that should be allocated to the finishing department. So as you recall, in chapter 19, the first half of the chapter was doing support department costs, and we used the direct method where no support department costs are allocated to any other support department. They're allocated directly to the production departments. And so how you allocate from one support department does not impact how you allocate from the other. The sequential method, however, does need to be done in step-down fashion. That is, we start with allocating one support department, whichever one is determined to go first. You will not need to determine that. You will be told at least the method for determining that. And in this case, we're told that cafeteria is allocated first. And so that means we allocate the cafeteria department not only to the two production departments, but also to the materials management department, the other support department. So if we're allocating cafeteria based on employees, we add up the number of employees excluding those that are in the cafeteria department. So since we are allocating to materials, molding, and finishing, we're going to add those together. Let me get my annotate up here. And so we would be allocating based on these employees. So 30 plus 25 plus 5, a total of 60 employees. And letter A asks us to determine the percentage of cafeteria costs that should be allocated to the molding department. So the molding department has 30 of the 60 employees, or 50% of the total costs of the cafeteria department will be allocated to the molding department. So this is a pretty quick exercise. We don't have to actually do any of the allocations. We're just asked for these two percentages. So once we've allocated to the, we've allocated the cafeteria department. Now all of those costs from the cafeteria department have been split among the molding, finishing, and materials department. And now we need to allocate the materials department. And so we're not including the cafeteria costs separately. In other words, they've already been allocated. They're already included within the materials, molding, and finishing departments. And we're now taking the materials department and allocating those to the remaining departments, that is molding and finishing. And so we are told to base it on the value of materials used by those two departments. So 1,900 plus 3,100 is a total of $5,000. And we're allocating, the question is, how much are we allocating to the finishing department? So it tells us that those costs are respectively, which means that 1,900 goes with the first department listed, which is molding, and $3,100 goes to the second department, which is the finishing, which is the finishing department. And so 3,100 divided by 5,000 is 62%. And so that's going to be our answer to part B, 62%. And we have now answered both of the required questions. So I'm just hitting my check my work button to get those green check marks in there. And we have completed our first exercise. And we will now move on to the second exercise. See, 1 second, let me just check down here, see if we have any other, before I move on to joint costs, I just want to see if there's one. So I apologize again for jumping around, but let's go down to exercise number 14, which is brief exercise 19.01. As I pointed out for our previous exam, the .algo at the end means these are generated algorithmically. And so if you were to, if you're doing this along with the video, then keep in mind that the numbers in my exercises for these algorithmically generated exercises, the numbers in mine may be different, probably are different than the numbers that you have in yours. And if you were to do this set of exercises more than once each time, it should deliver different numbers so you can practice again if you choose to do that. So we're jumping down to 19.01 because this is still based on the first part of the chapter, which is support department cost allocation, and this is the direct method. And so the direct method means that we are allocating each support department independently. That means we can do one without any knowledge about how the other one is working. They're totally independent. So this says Charlie's Woodworks produces wood products, cabinets, tables, picture frames, and so on. Production departments include cutting and assembly. The janitorial and security departments support the cutting and assembly departments. Assembly department spans about 47,560 square feet and holds assets valued at about $76,000. The cutting department spans about 34,440 square feet and holds assets valued at about $114,000. Charlie's Woodwork allocates support department costs using the direct method. If costs from the janitorial department are allocated based on square feet and costs from the security department are based on asset value. Determine the percentage of janitorial costs that should be allocated to the assembly department. So again, as I just read, the janitorial is allocated based on square footage. So we need to know the total square footage just for the production departments. Because remember, the direct method means that we are not allocating any cost to support departments at all, unlike we saw in the first exercise. And so for the assembly department, it is 47,560 square feet. And we want to know how much is that of the total square footage strictly for the production departments. And so the total square footage for the production departments is the combination of assembly and cutting. 47,560 plus 34,440 is the total. And we want to know 47,560 is what percent of that. And when I plug that formula into my calculator, I got 58%. And security costs are allocated based on asset value. And we want to know for the cutting department. So the cutting department's assets are estimated to be worth 114,000. And that is what percent of the total? And so again, as I plug this into my calculator, I got 60%. And so to take this to the next step, then we're not asked to do this for the exercise, but I just wanted to, since you may be asked to do more than this on the exam, just recall that we would then take the total cost for janitorial and allocate 58% of those to assembly, and that means the other 42% would go to cutting. And then for the security costs, if we had the total cost for security, we would allocate 60% of that to cutting, and of course the other 40% would go to assembly. You could be asked on the exam to do something like what we have here. You could be asked, what is the dollar amount that's allocated to a particular department? You could be asked for a total cost for a particular department, which would mean doing the full allocation and then including the direct cost for that department as well. So if you want more review of that, I would recommend that you go back to the exercises from chapter 19, where we did go through all of that at the time. Now, the second half of chapter 19 was the joint cost allocation, where you're doing production together at the beginning of the process, and we need a way of separating those costs to apply them or allocate them to the individual products to make sure we have a firm grasp on the total cost of production. And so we're going to start with, we're going to go back to exercise 2 in this set, which is 19.14. And this is one of the 4 methods. We have an exercise for each of the 4 methods. So we're going to go through each one of these. You'll notice that this one is not an algorithmic problem. So that means that the numbers I have in my exercise should be the same as the numbers that you have in your exercise as well. Allocate the joint cost of production to each product using the net realizable value. And so what we did in the exercise in the chapter is set up a table, and I would encourage you to do that here as well. So the allocation is actually going to be the last step of that table. So I'm just going to add in, change my color here. I'm going to add in some additional columns that are going to make it easier for us to see this. So cups, market value, I'm just abbreviating here to make this a little bit cleaner. Market value per cup, total market value, market price. Wow, they have to move. Shoot. Well, I'm going to have to give myself a little bit more room here. So let me, I apologize, clear that. And let's try this again with a little bit more room. There's a lot of columns here, as you may recall from working on this in the chapter. And let me start over. So cups, market value per cup, total market value at split off, market price, market price per cup, added cost per batch, total net realizable value, greater of net realizable value and market value, portion, percentage, and then we have the joint costs. Okay. So we'll be using each one of these columns as we go through this exercise. Lily's Lemonade Stand makes 3 types of lemonade: pure, raspberry, and strawberry. The lemonade is produced through a joint mixing process that costs a total of $30 per batch. And so I'm going to go ahead and put that $30 over here for each one of the rows. So it's those $30 that we are going to be allocating. And when we finish this exercise, then the allocation to each one of the 3 products needs to total that $30. Those are the costs that are incurred up to the split off point. One batch produces, and I'm going to be filling in this information in the table so you can see where it goes as we move along. One batch produces 32 cups of pure lemonade, 21 cups of strawberry lemonade, and 21 cups of raspberry lemonade. So I'm kind of trying to line those up along the rows. After the split off point, all 3 lemonades can be sold for 80 cents per cup. Sorry, but strawberry and raspberry lemonade can be processed further by adding additional artificial coloring and flavoring and sold for 95 cents and $1 per cup. Okay, so this is our market price per cup. It is 80 cents for the pure lemonade, and we can sell the strawberry for 95 cents and the raspberry for $1. It is estimated that additional processing costs are 75 cents for strawberry. So there are no additional processing costs for the pure lemonade that would be sold as is at the split off point. And $1.80 per batch for the raspberry lemonade. It is estimated, yep, okay, we got all that. So let's get my calculator here. And we'll go about filling in the rest of these columns. So the market value per cup at split off, I could have filled this in with what was given. So that's 80. If we just sold it at the split off point, rather than processing it further, we could sell each one of them for 80 cents per cup. So the total market value at the split off, just multiplying each one of these times 80 cents. So if we sell it as just pure lemonade at the split off point, 1680. Okay. And so for the pure lemonade, if we sell it as pure lemonade we would get $25.60. There is no additional cost. For the strawberry lemonade, yes, we could sell it for, oh, and I didn't do that extra column here. So I need to do one more calculation here. So if we do the addition of the artificial coloring and flavoring and sell it as strawberry, we could now sell it for 95 cents. 21 cups at 95 cents is $19.95. But we would have to pay the extra 75 cents to process it. And so the total net realizable value is $19.20. Again, let me review that calculation. So I took the 95 cents per cup that we could get after the additional processing times 21 cups is $19.95, but we have to subtract that 75 cents of additional processing cost. And we're going to do the same thing for the raspberry lemonade. We would have 21 cups. We could sell each one for $1. So we would bring in $21 in revenues, but we'd have to pay an extra $1.80. And so the total net realizable value for the raspberry lemonade would also be $19.20. Okay. So 32, put a total down here. So how many cups do we get total per batch? That is 32 plus 21 plus 21. That's a total of 74 cups. And so 32 out of the 74 cups. Oh, let me do that a different way. Whoops. A line there. And a line here. Need to do that next column first. Got ahead of myself. So of the total net realizable value compared to the total market value, we're going to choose the greater of those two columns. So why do we do that? Well, if the market value at split off is more than the value after the additional processing, then there'd be no incentive to do that additional processing, or maybe very little incentive to do that additional processing. But for this, in this case, the market value after the additional processing is higher for all three items, or of the same for pure lemonade, and higher for the other two. So let's add those up. 6, whoops, plus 1920 and 1920. And so the total market value is, or net realizable value is $64. So now we can do our proportion. 2560 is what percent of the market value, and that would be 40%. 2560 out of the total of $64. And then we can do the same thing for the 1920 out of 64. And for each of the other two products, then it makes up 30% of the net realizable value. So now we can do our allocation. And I've got the column over here at the beginning. That's what's actually asked of us. So if pure lemonade makes up 40% of the net realizable value of this product, then we're going to assign 40% of those joint costs to pure lemonade. So the joint costs we already know are $30, and we're going to assign 40% of that, or $12, to pure lemonade. We're going to assign 30% of that, or $9 each, whoops, $9 each to the strawberry and raspberry lemonade. And so I would encourage you to approach this in the table format as I have done here, because it does make it easier to organize your thoughts, organize your information. And let's go down and get our green check marks in there. And that is the net realizable value method. We started with this one, probably didn't need to start with that one. That one's definitely the most involved or most complex of the 4 methods. So I'm going to go ahead and clear my drawings. And as I already explained, we're going to be jumping back down to the exercises at the end, starting with exercise 11, which is market value at split off method. And again, we'll be making a table, and I'm going to make myself a little bit more room here to make that table. So obviously, when you are working on this, you are not going to be writing on your screen. I would encourage you while you're taking the exam to have a notepad to do your calculations on that notepad. And again, the first column that we're given here where we need to input our answers, that's really the final step of the calculation. And so for market value at split off, we need to know how many handles there are. Let me just read the exercise to us first. Grip Turn Incorporated produces 2 different styles of door handles, standard and curved. The door handles go through a joint production molding process costing $26,000 per batch. So we already know that's how much we're going to be allocating. We have to figure out of this $26,000, how much is allocated to standard and how much is allocated to curved door handles. Excuse me. So the very last step is going to be where does that $26,000 go? So keep in mind that the $26,000 is the number in my exercise, that we're back to an algorithmically generated exercise. I think actually all of these are algorithmic from this point forward. And so while the process I follow is going to be the same as what you would need to follow, you will need to redo these calculations using the numbers that are in your own exercises. The batch produces 2,200 standard door handles and 1,100 curved door handles. So that is a total of 3,300 door handles per batch. Both door handles undergo additional production processes after the split off point, but could be sold at that point. The standard style for $6 per door handle. So the price at split off for a standard door handle is $6, and the curve style is $3 per door handle. So the market value at the split off for standard door handles, we'll have 2,200 of those door handles, and we can sell them for $6 each for a total of $13,200. And we have 1,100 curved door handles that we can sell for $3 each for a total of $3,300. So the total market value at split off would be, and using my number, $16,500. So if we're going to allocate the joint costs of, in my exercise, $26,000 based on this market value, we need to know what percent or proportion each of those makes up. So 13,200 out of 16,500 is 80%. And that means the curved door handle must make up the rest, or 20%. Again, those should always add up to 100%. So since we know we're allocating $26,000, $26,000 times 80%, 80% of those costs will be allocated to the standard door handle. 80% of 26,000 is 20,800, and the other 20%, or 5,200, would go to the curved door handle. And your numbers are going to be very different, could be very different than mine, but the approach, the calculations, you will go about in exactly the same manner. All right, so if there aren't any questions, we will keep going. Of course, if you are watching this on the recording and you have questions about anything I do, you are absolutely welcome to ask questions. You can send me an email or ask for a meeting on Zoom if you want to go over something with me. That's always fine. And our next exercise is the joint cost allocation. So yet another of the 4 methods that we have. And again, I'm going to set this up as a table. And I would encourage you to do the same on your scratch paper. Konami Code Gaming produces 2 types of high-end gaming controllers, one with a casing made of a polymer that looks like walnut wood, and another with a casing made with a polymer that looks like red oak. The casings are made through a joint production molding process that produces 315. So I might as well just go ahead and put those in. The number of cases or casings. And I think this is another algorithmic problem. So make sure you're using the numbers that you have in your exercise, not the ones that I have in mine. Casings are made through a joint production molding process that produces 315 red oak casings and 210 walnut casings at the split off point. The polymer for the red oak casings requires twice as much cooling time as the polymer for the walnut casings, although all casings are removed from the joint molding process at the same time. The joint production process costs a total of $5,500. So in my exercise, it's the $5,500 that we are allocating to the 2 products. So it tells us that the red oak casings take twice as much time. And so that is going to be the weight factor that we use, assuming, reading that last paragraph, assuming the company allocates joint costs using the weighted average cost method on the required cooling time of the 2 joint products. Determine the amount of joint production costs allocated to each type of casing using the weighted average method. So the weight we're going to apply, the weight factor, is going to be, get this to line up a little bit anyway. There we go. 2 for red oak and 1 for walnut, because it takes twice as much time for the red oak. So now we can calculate our weighted average number of cases. So if we apply a weight of 2 to that 315 times 2 would be 630, and a weight of 1 to the walnut casings would leave that at 210. And let's get our total then. Our total 630 plus 210 would be 840 cases. And we can then express that as a percent. So for the red oak casing, 630 divided by 840 is 75%. And of course, then that leaves to 25% for the walnut casings, because again, those weights need to add up to 100%. So of the $5,500 in joint costs, we're going to assign or allocate 75% 75% of 5,500 is 4,125. We're going to allocate to red oak. And 25% of 5,500, 1,375 to walnut casings. In case you're thinking, but wait a minute, the weight on red oak was twice as much. Why are those costs more than twice as much? It's because we actually get more of the red oak, or we do more of the red oak casings as well. Okay, so that one also a little bit simpler. And our final exercise related to joint cost allocation is probably the easiest. So we went kind of from hardest to easiest here. Let's go to that next exercise. And this one is probably the easiest exercise. You still can set up that table if it helps you to think about it that way. I would probably encourage you to go ahead and do that, just because it is consistent with the way we're approaching all of these. So just keeping in mind which approach we're using. And this is the physical units method. So I won't have as many columns as we did on the first, because we only need to look at the units and then what percent those units make up. We don't have to do any weights. We don't have to look at market value at split off, or that, the most challenging, the most involved process was, as we saw in the very first exercise related to this joint cost allocation, the net realizable value is the most involved calculation. So as I've said in earlier exercises, in earlier situations, so how do we know which one of these we want to use? Well, my recommendation is you use the one that is the easiest to use while still giving us a good sense of what our costs are for each product. So if the physical units method gives us a good sense of our cost, go ahead and use that because it's the easiest. So you don't need, this isn't something you're going to test every month or even every quarter or every year. You're simply going to make a decision for your company and stick with that. The consistency convention in financial accounting is pick a method and stick to it. And does that mean we can't ever change? No, of course not. We can reevaluate at some point down the road and say, does this method still work for us? Is it still giving us a good sense of our costs? But certainly we don't want to be, reevaluating that and changing on a monthly basis. We want to be consistent with whichever approach we chose. Medieval Blacksmith Company produces two types of decorative swords, a broadsword and a longsword. The swords are made through a joint production process that ultimately produces 48 broadswords, 12 longswords. And so that's a total of 60 swords. The additional production process of the broadsword costs $48 per sword, after which it is sold for $174 per sword. The additional production process of the longsword costs $20 per sword, after which it is sold for $152. Determine the amount of joint production costs allocated to each type of sword using the physical units method. So the joint production costs were just $3,800 in my exercise. The joint production costs were $3,800. My annotation back up here. And so we need to know what percentage of the swords are broadswords. 48 out of 60 is 4/5 or 80%. And 12 out of 60 would be 1/5 or 20%. And so again, easiest approach we have is just using those units to assign or allocate those joint production costs. Of the $3,800, of the $3,800, we're going to allocate 80% or $3,040 to broadswords, and the other 20% or $760 goes to longswords. So you'll notice there was some additional information given here about the additional process production costs and the sale price after the the additional production costs. Those would have been important for us for the net realizable value method, but we did not need that information. It was extraneous. We did not need that to use the physical units method. All right, and that is our final exercise from the chapter 19 exercises. I'm just jumping back here to number 14 because I realized I never put in my green check marks, and so that exercise was showing that we hadn't done that one yet. But I obviously knew that we had. So that's chapter 19. We did two different concepts, the support department cost allocation using two approaches, and the joint production cost using 4 approaches. And so you would need to know all 6 of those methods from chapter 19. Let's move on then to chapter 20. And the first exercise from chapter 20 is exercise 6. Just occurred to me, maybe the reason these are jumbled around may not be the way I set it up. It's possible that the exercises come in a random order. Not sure about that. So what I'm looking at now is the brief exercise 20.05. We are looking at the CVP, or cost volume profit analysis. And remember, I already pointed out to you this useful formulas page here in Brightspace, and that's what we will be using. So this is a sales mix and break-even analysis. So our formula that we have for break-even analysis, this number of the units calculation here, includes in the denominator the contribution margin per unit. But for a sales mix problem, we have more than one product, and so we probably have more than one contribution margin. And so the very last bullet point down here at the bottom reminds you to calculate the weighted average of the contribution margin for each product, and then you would add them together to find the contribution margin per unit for the average selling unit. So let's go ahead and get my annotate back up here. And I'm just going to be putting a calculation over on the far right of this table. So Megan Company has fixed costs of $1,322,520. The unit selling price, variable cost per unit, contribution margin per unit for the company's 2 products follow. The sales mix for products, Yankee and Zorro, is 60 and 40. All right, so 60% and 40% respectively. So again, that respectively means that the 60% goes with the first item listed, Yankee, 40% goes with Zorro. Determine the break-even point in units of Yankee and Zorro. So keep in mind, this is asking for units, but we certainly could be asked to find the break-even point in sales dollars as well for each product, in which case you still start with calculating the units and then simply multiply by the selling price per unit to find our sales dollars. So first column I'm going to add here is the percent of the sales mix. And we were told that that's 60% Yankee and 40% Zorro. So that's important information to have. As we were working on this chapter, we talked about the importance of that sales mix being predictable and relatively stable. So the more uncertainty we have about that sales mix, the less reliable or robust our calculations here are going to be. And that's why we talked about that concept of you having a margin of safety built in if we're not really sure about that, about our estimates or our conjecture, our assumptions. So again, we have that sales mix of 60 and 40. So now we can work on the weighted average by taking the contribution margin per unit and multiplied by that sales mix. Now, in this case, we already have the contribution margin per unit calculated for us, but of course we know that contribution margin per unit is the selling price minus the variable cost. So if you were not provided that, you certainly could calculate that yourself. So $210, our contribution margin is $210 60% of the time. So 60% times 210. And the other 40% of the time, it's $220. So that contributes $88 toward our total. I'm going to add those two together to find our weighted average contribution margin. 126 plus 88 is 214. I would encourage you at that point to do what I think of as a reasonableness check. Does that even make sense that our weighted average contribution margin would be 214? Well, sure, because it has to be somewhere between 210 and 220. Those are the individual contribution margins. And we know it's going to be closer to the 210 than the 220 because we sell more Yankee at 210 than we do Zorro at 220. So now we have that weighted average contribution margin per unit, and we can go ahead and find our break-even units. So we're going to be using that formula that I have showed you a couple times now in Brightspace in the Chapter 20 Reference Materials folder. So that formula says fixed costs plus profit in the numerator. Fixed costs are given, but this is the break-even point that we're calculating. So I'm just plugging in a 0 for that profit number. And then we divide by the weighted average contribution margin per unit, which is, we just calculated, $214. So the way I would like you to think about this is each unit that we sell contributes on average $214 toward our fixed costs. If our fixed costs are $1,322,520 and we're covering that $214 at a time, how many units do we need to sell? So if each unit is contributing on average $214, we would need to sell 6,180 units to break even. Of those 6,180 units, we know that 60% of those are going to be Yankee. 60% times 6,180 is 3,708. That would need to be Yankee units. And 6,180 times 40% of those will be Zorro, or 2,472. As I explained already, if the question asked for break even in dollars, we would simply take these units and then multiply by the selling price per unit that was given, $360 for Yankee, $610 for Zorro. Okay, so that's how we do the sales mix question. And again, it's very important that we can accurately predict what our sales mix would be and that it would remain relatively constant throughout the period that we're evaluating. And let's go ahead to our next exercise, which is a target profit question in my set. It's exercise number 7. It's brief exercise 20.04. Forest Company sells a product for $195 per unit. The variable cost is $100 per unit. And fixed costs are $769,500. First question is to find the break-even point in sales. So first thing I want to do is calculate my contribution margin per unit. I'm going to put that here on the screen. We sell for $195 and 100 of that is variable cost, which means we have $95 using my numbers. This is another algorithmic question, so make sure you're using your own numbers. So for my exercise, $95 is the contribution margin per unit. So to break even, using again that same formula, we use that formula every time. We take our fixed costs for break even. We know that the profit is 0, and we divide by our contribution margin per unit. So if each unit contributes $95 toward the bottom line, how many $95 contribution margins do we need to break even? And the answer I got using the numbers in my exercise is 8,100 units. That's going to be our answer for part A. And for part B, break even if we want to. Yeah, so they really shouldn't call that break even point. I'm going to ignore that. So I'm going to say number of sales units required for the company to achieve a target profit of 169,290. It's not break even if you're making a profit. And so this was our answer to letter A. And let's go to letter B now, but I'm not calling it break even point. That really should not be in there. So we're going to call it just number of units. And now we're going to be using that full formula where we start with our fixed costs, add the profit to it. So the book kind of talks about it like these are two separate formulas, but they're really not. They're the same formula. I think it's easier to think of it as just one formula, where if you're finding break-even point, you plug in 0 for the profit, because that's the definition of break-even. So there's our fixed cost plus profit divided by $95 per unit. Let's see what we get. And I got 9,882 units. I'm going to show you another way we could have done that. Since we already knew the break-even point, we could have just said additional units. So once we hit the break-even point at 8,100 units, how many more units do we need to sell? We've already covered all of our fixed costs. And so we would need to sell an additional 1,782 units. You could be asked that. You could be asked that question like that. How many more units, how many additional units would they need to sell after break even to reach this profit? And so 1,782 additional units on top of the 8,100 units we sell to break even. 8,100 plus 1,782, get the same answer. And so I guess it's a question of, which approach are you more comfortable with, and how much extra calculation is involved here. I'm always a fan of using the simplest approach possible. So since we had already plugged in the 769,500 in fixed costs, might be easier just to calculate how many extra units and add that to the number we already knew. It's really completely up to you which approach makes you more comfortable, which approach you think is faster, but also likely to lead you to the correct answer. And let's go on then to the next exercise in my set, brief exercise 20.03, again, an algorithmically generated. And we start out with the break-even point again. So let me put some calculations here on the screen. In order to use our formula, we need to know the contribution margin per unit. I like to put that here on the screen. So $88 as the selling price minus the $41 variable cost gives us a $47 per unit contribution margin. Letter A asks us for the break-even point in sales units. So again, using that formula, break-even units is the fixed cost given as in my exercise 865,928 divided by the contribution margin per unit. So our answer to letter A is 18,424 units. And part B says, well, what if we increase the selling price to $97 per unit? We'll assume that nothing else changes. And so if our selling price changes, our contribution margin is also going to change. And we assume that nothing else changes. So variable costs we'll assume are still $41. If we increase the selling price by $9, that will increase our contribution margin by $9 as well. So it goes from $47 to $56. And then we're going to do the same calculation. It doesn't say that our fixed cost changed, although certainly that could be part of this question. You know, it could say something like, what if we raise our selling price to $97, but that raises our fixed costs by $20,000 for the additional advertising? I don't know. So we could be asked to manipulate any one of those given values. 865,928 divided by $56. So increasing our selling price, as we would not be surprised to find out, increasing our selling price also decreases our break-even units because there's more contribution margin left from each unit sale. Now, one thing I just want to point out is from an economic standpoint, we have to recognize that raising our price means that we will sell fewer units. That's the law of demand. So we have to take that into account. It's not just a matter of, hey, we can just raise our price and then we have more money. Our sales are almost guaranteed to drop if we raise our price. We won't get into it here, but if you've taken economics, you know that there's a question of elasticity that is involved in how sensitive our customers are to a change in price, how much our product sales will drop. But we can rest assured that if we raise our price, our sales will drop. So the question is, will they drop enough that it means it's not worth it to change our price? And I can't answer that given the information that we have here, certainly. But since this whole semester is really about making business decisions using accounting information to make a business decision, it is important to keep that kind of a question in mind, that we're not making decisions in a vacuum, that we are making those decisions based on other impacts, that what else is going to change. It's not ceteris paribus is the economics term for all else equal. Well, in reality, other things will change. So our last two chapter 20 exercises here are related, are really from the beginning of the chapter, where we were talking about fixed and variable costs and a mixed cost, which has a piece that's fixed and a piece that's variable. Well, we know that there are a number of different ways that we can separate these costs, but for our purposes in this class, the only one that you are responsible for knowing how to do is the high-low method. And so in this exercise, we're given the manufacturing costs of Schrader Industries for the first 3 months of the year. We have to identify the high point, which would be March, and the low point, which would be January. Now, in the video for the practice exercises for this chapter, I talked about this in the context of the slope-intercept form of a line. And if you're familiar with that from geometry class, then that might be a better way to think about this. But if you're not familiar with it, that's okay. You can still approach this. The calculations are the same, but they just might not, click in your mind as much. How exactly or what exactly are we doing with this? But you can just follow the steps that I'm providing to do the high-low method without thinking about it in terms of the equation of a line. So again, we start by identifying the high and the low points. We have to decide which of these pieces of information we're using to predict the other. And in statistics, we would call that the independent variable or the X variable. Whoops, didn't mean to put it. So in this case, we're using units produced to predict total costs. So if we were putting this on a graph, we would put the units produced on the x-axis and the total costs on the y-axis, because we're trying to, we believe that the more units we produce, the higher our costs will go, and that we can use units produced to predict costs. One other point, the data range that we have here, the relevant range, goes from 630 units to 2030 units. So it would not be appropriate for us to use the results of this analysis to predict our costs if we had only 200 units produced or 20,000 units produced. We don't have any data in that range, and so we don't have reason to believe that the relationship that we're going to construct here applies for that number of units produced. The farther we get outside our relevant range of 630 to 2030, the less valid, reliable our model is going to be. And so we now want to find out the change in units produced. So change in units, 2030 minus 630. So the range, or the change in units from our high to our low point. (2030) minus 630 is 1400. Unfortunately, my calculator is telling me it's running low on battery. And then we want to find the change in total cost, which is the variable we're trying to predict. In statistics, we would call that the dependent variable. And so our cost changed 70,000 when our units changed 1,400. And so now we want to find the change in total cost per unit. So we're taking the 70,000 and dividing by the 1,400 units. And it's a change of $50 per unit. That's actually our answer to part A, the variable cost per unit. Our costs went up by $50 for each additional unit that we produced. So that's going to be our answer to part A. Now for part B, we can choose either one of the points, January or March, our high or low point. I'm going to use January because the numbers are smaller, so it makes our calculations easier, but you'll get the same answer regardless of which point you use. So for January, the total costs were $126,000. And based on what we just calculated, that it was $50 per unit, and we produced 630 units, that $50 times 630 would be our total variable cost, and whatever's left would be the fixed cost. So I just need to solve this. If our total cost is 126,000, and 50 times 630 was our variable cost, so we subtract that, we are left with our fixed costs, 94,500 in my exercise. And so that's our answer to part B. $50 per unit is the variable cost. 94,500 then would be the total fixed cost. So what do we do with this? Well, if we're trying to predict the cost for, let's say, the month of April, if we know how many units we would expect to produce in April, or plan or budget to produce in April, we can predict our total cost. Let's say we were going to produce, I don't know, 1,000 units. That's within our relevant range of 630 to 2030. And so I must annotate here. And so for the month of April, the way using this is my example. This goes beyond what's in the exercise. I just want you to see how to use this. If we produce 1,000 units, each one of those, we would expect to contribute an extra $50 in variable cost. And then we would have the 94,500 in fixed costs. So we have 50,000 in variable, $50 times 1,000 units, plus 94,500 in fixed costs. Our total cost for April, we would predict, whoops, an extra button there. We would predict would be 144.5. So this using this high-low method and setting up the formula for total cost of number of units times variable cost per unit plus fixed cost gives us a way of predicting what our cost would be in a future month. Well, what if we produce this number? What if we produce that number? We can use that same basic formula or template to predict the total cost for that month. Our last exercise for chapter 20 is about contribution margin. Sally Company sells 23,000 units at $35 per unit. Variable costs are $29.75 per unit, and fixed costs are $48,300. First thing we're asked to do is calculate the contribution margin ratio, and then the unit contribution margin and operating income. So it actually makes more sense for us to calculate the contribution margin as a dollar first. Get my annotate back up here. And so if our selling price is $35 per unit and our variable costs are $29.75, again, your numbers may be different. 35, so the selling price minus the variable cost gives us our contribution margin. That's in dollars, and that's our answer to part B. I really don't have any explanation for why they would ask you to do part A first, because you need the dollar amount first. Okay. So we have $5.25 per unit. And now we can do that as a ratio by taking the contribution margin of $5.25 that we just calculated and dividing by the selling price. $5.25 as a percent of the selling price. $5.25 divided by 35 is 15%. And that's going to be our answer for part A. And then we're asked to find our operating income. So there's a couple ways you could go about this. I am just going to do it using the contribution margin income statement format that was included on those useful formulas that I started out showing you in Brightspace. So let's start with our revenues. 23,000 units at $35 per unit. Then we subtract our variable costs, $23,000 at, and I'll talk about in a minute the other way we could go about this. I think this is probably the way that's most familiar to you, thinking about operating income in an income statement format. So we start with our revenues, we subtract our variable costs, we subtract our fixed costs, and that will give us our operating income. And I got $72,450. So again, I set this up in the contribution margin income statement format, revenues minus variable costs minus fixed costs. Another way we could have done this, making this simpler using what we already knew. We know that we have $5.25 in contribution margin for each of the 23,000 units. So that's what's left after we cover our variable costs, and then we can just subtract our fixed costs. We would have gotten the same answer either way. So again, I would encourage you to use whatever format is most comfortable for you. So sometimes it's about doing it quickly, but it's way more important to do it well, to do it correctly. And if you're not comfortable with the contribution margin approach that I used in the second line there, I would suggest that you don't use that, right? Okay, so we finished 2 chapters, and now we can go back to our chapter 21 exercises. And I think I'll do these in order, in the order of the number of the exercises. So this is 21.03, and this is the 5th exercise in my set. I just don't know if it's the 5th exercise in your set. So income statements under absorption and variable costing. One moment here. Fresno Industries Incorporated manufactures and sells high-quality camping tents. The company began operations on January 1st and operated at 100% of capacity, 77,000 units during the first month, creating an ending inventory of 7,000 units. During February, the company produced 70,000 units during the month, but sold 77,000 units at $120 per unit. February manufacturing costs and selling and administrative expenses were as follows. Okay. So remember, the difference between absorption and variable costing is what we do with the fixed costs for the units that are in ending inventory. We know that for GAAP purposes, for financial reporting that you covered in financial accounting for most of you last semester, that we have to treat those fixed costs as part of the cost of the product. And so the fixed costs, if we inventory the product, that is, we don't sell it, those fixed costs would be transferred to inventory. They would be sitting on the balance sheet as an asset. But for management decision making, that may encourage, let's call it inappropriate, non-business friendly practices of producing for inventory to kind of hide some of those fixed costs. And so that is why we introduce the concept of treating the fixed cost as a period cost rather than a product cost. And what that means is, given the information we have here in January, when we produced for inventory, we ended up with an inventory at the end of the month. We would still expense all of those fixed costs in the month of January. And in February, when we sold off that inventory, we would actually look more profitable because we would not be shifting those fixed costs out of inventory onto the income statement. So we're given a table here of information about the number of units, unit cost, total cost for February. And we're asked to prepare an income statement according to the absorption costing concept for the month of February. And then we'll do one for the variable costing concept for the month of February. So we'll start with absorption costing. So we know that because this is an income statement, of course, we're going to start with our sales or our revenues. And what did it tell us? We sold 77,000 units at $120 per unit. So 77,000 units at $120 per unit. For my exercise, because remember, this is also an algorithmic one. So for my exercise, these sales would be $9,240,000. Yours might be different, but it's always going to be, of course, the number of units at the selling price. Then we have our cost of goods sold. Well, we have to figure out our cost of goods sold. So we'll start with our beginning inventory. We'll add to that the cost of goods manufactured to get the, actually, let me point out something. I know I mentioned this already, but so they produced 70,000 units, but they sold 77,000. And so that means they sold all the ones they produced in February plus that ending inventory. And so we've made this a little simpler on ourselves because we don't have any ending inventory at the end of February. So our cost of goods sold is going to be, what did we start with and what did we manufacture? Because again, we don't have anything left at the end of the month. So that will be our total cost of goods sold. If we once we subtract that from revenues, we're left with gross profit, or what I prefer to call gross margin. Subtract from that our selling and administrative expenses to get our operating income. So what do we already know? We have selling and administrative expenses for February, and there's the total, $2,340,800. Our manufacturing costs in February, including the fixed and the variable, $4,746,000. I'm just plugging in what I can for now. And what we still need to figure out is our beginning inventory. And so, come on then. So in the month of January, we had produced 7,000 additional units beyond what we sold. So those 7,000 units are sitting on our balance sheet. Under absorption costing, which is the one that is required for GAAP, we include both the variable and the fixed manufacturing costs as inventory. Under variable costing that we're going to do next, we would be looking at only the variable costs because those fixed costs would have been expensed in the month in which they were incurred. So what does this mean for our exercise? For absorption costing, that beginning inventory is going to include the fixed and the variable, a total of $66 per unit. And how many units did we have in beginning inventory? 7,000. So 7,000 units at the total, all in, fixed and variable cost. In my exercise, that's $66. So that's 462,000. So 462,000 would be our beginning inventory under absorption costing, where we're including the fixed manufacturing cost along with the variable. And then we subtract that from the revenues to find our gross profit or gross margin. Now, this exercise doesn't tell us whether to use negatives or positives. So if it helps you to remember to subtract, certainly, because it does not say, you can put those negatives in there. At least normally it will allow you to do that. So that's really a software question. But my experience with this software in the past has been, if it doesn't specify whether to use negatives or positives, it will accept either one. Okay. And so our operating income under absorption costing is $1 million, about $1.7 million. Now we're going to be basically repeating this down here in the variable costing income statement, at least the approach that we take. So sales, and we then subtract our variable costs of goods sold to get our manufacturing margin. That was the new concept that we introduced in this chapter. Then we subtract the variable selling expense to get our contribution margin. We're then going to subtract the fixed costs. And the fixed costs will include our fixed manufacturing and fixed selling and administrative expenses. And from there, we'll get our operating income. Now, we know that that operating income bottom line is going to be different under variable costing than under absorption costing because we produced for inventory in January. We would have included all of the January fixed manufacturing costs already on January's variable costing income statement. So we know that under variable costing, our income is actually going to be higher. Why? And by how much? It's going to be higher because of how we treat those fixed manufacturing costs when we're producing for inventory in January. Our income would have been lower because we'd include all of those. And in February, our income is going to be higher under variable costing because we're only including February's fixed manufacturing costs. So let's start plugging in our numbers. And where I can, I'm just going to pull those numbers like the sales number is going to be the same. How much we charge our customers has nothing to do with whether we're using absorption or variable costing. The variable cost of goods manufactured is going to include the variable costs from February, which we know right here, but it's also going to include the variable costs that were from January that carried over on our balance sheet. And so we're not, there's what I have highlighted there on the screen, the variable cost beginning inventory, $336,000. We're going to add to that the variable costs that were incurred in the month of February, $3,360,000. And so our total variable cost of goods sold, $3,696,000. Again, you can use the negative there if that helps you to remember to subtract. Now we have our variable selling and administrative expenses. Well, all of the selling and administrative expenses from January, those are period expenses, and those would have showed up on our January income statement, regardless of whether you're using variable or absorption costing. And so we only want this number I have highlighted, the variable selling and administrative in February, $1,801,800 in my numbers. And your numbers are likely to be different. So I want to make sure I copied that right. Again, I can use the negative. And now we have our, whoops. Go. And now we have our contribution margin. So we already knew contribution margin from the CVP analysis chapter, chapter 20, but in this chapter we introduce that new additional step there, the manufacturing margin. Okay, here's where our difference comes in. For the fixed costs, our fixed manufacturing costs are only going to include those that were incurred in February. Under under absorption costing, these $126,000 in fixed costs had carried forward on the balance sheet as an asset. But under variable costing, we're only including the fixed costs from the month of February, $1,386,000. And the fixed selling and administrative expenses, of course, those are always included in the month they're incurred because those are a period cost. And again, you can put a negative there when you total those if it helps you to remember to subtract. And so what do we see? The operating income, $1,817,200. We already knew that was going to be higher than the operating income under absorption costing. How much higher is it? I subtracted the one, I went from 1,817,2 down to 1,691,2. And the difference between those two numbers is 126,000. And there is that number. It's the fixed cost from the beginning inventory. Under absorption costing, as we're required to use for financial reporting purposes, those would have been on the balance sheet and they would be expensed in the month that we sold the product. Under variable costing, we would have expensed those in January and not carried them forward as an asset. So again, the whole one of the points of variable costing is that it helps us to incentivize the right behavior, that is producing because we have an order, not because we can. It's that concept of pull-through production. Letter C, what is the difference? What is the reason for the difference, the amount of operating income reported in A and B? So under the blank method, the fixed manufacturing cost included in the cost of goods sold is matched with the revenues. And so that would be the absorption costing. Under variable costing, all of the fixed manufacturing cost is deducted in the period in which it is incurred, regardless of the amount of inventory change. Thus, when inventory decreases, which one has a lower income? So this is what we just saw. Absorption costing has a lower income because of those fixed costs coming out of inventory, coming off the balance sheet as an asset and being moved to the income statement as an expense. Not in the month that the product was made, but in the month that the product is sold. Okay, and if there aren't any questions on that, we have, let's go back to, in my exercises, it is exercise 4, exercise 21.12. And this is product profitability analysis, exercise 4. Galaxy Sports Incorporated manufactures and sells 2 styles of all-terrain vehicles, the Conquistador and Hurricane, from a single manufacturing facility. The manufacturing facility operates at 100% of capacity. The following per unit information is available for the 2 products. So we have the kind of the per unit breakdown there for each one of those products. In addition, the following sales unit volume information for the period is as followed. So we sell more of the Conquistador than we do Hurricane. Prepare a contribution margin by product report. Compute the contribution margin ratio for each product as a whole percent. Okay, so contribution margin by product. So let's start with our sales and subtract from that our variable cost of goods sold to get our manufacturing margin, and then our variable selling expenses to get our contribution margin. And then the last thing we're asked to find is the contribution margin ratio. So if we're selling 2,500 units of Conquistador, we are going to take 2,500 units and multiply by each one of these selling prices. The selling price, 2,500, whoops. It's an extra step with my calculator each time since it thinks it has a low battery. So 2,500 units at $6,200 each, 15,500. Okay, so 15,500,000. Variable cost of goods sold is 39.10 each for the 2,500 units, or 9,775, 9,775,000. If we subtract that, we get our manufacturing margin, multiply by the variable selling expense of $988 per unit. I think in the interest of time, I will do the Conquistador column and then and let you do the Hurricane column on your own. Aware that this video is getting quite lengthy. So the contribution margin of 3,255,000 in the numbers in my exercise, to get the contribution margin ratio, we would divide that number by the sales figure. And just as an aside, we could have done that based on the per unit, you'd get the same answer. So we could have taken the 1302 and divided by the 2600. To show you that that works, I'm going to just do that calculation for Hurricane. 684 divided by 3,800, selling price is 18%. And so I'm going to check my work button. And as I said, I'm going to let you fill in the hurricane column on your own. I think if you can do it for one column, you can do it for both. The calculations are the same, or the approach is the same. And then certainly you can answer part B on your own as well. And let's go to our final exercise for this set. It's a pretty lengthy practice set to get ready for the exam. And let's try to do this a little bit speedier. This is a segment contribution margin analysis. The Walt Disney Company is a global entertainment company organized into 4 business segments. I don't think I need to read through all of those. We don't need to know all of that information to do the exercise. For a recent year, Disney reported the following segment results in millions. We have revenues, operating expenses, operating income. And then we have the percentage of variable operating expenses for each one of the segments. Prepare a variable costing income statement for the Walt Disney Company by segment. If required, use a minus sign to indicate an operating loss. Round all amounts to the nearest million. So again, I think once we start with this, you can fill in the gaps, because the approach is going to be the same for each one of these columns. So this is a variable costing income statement. Of course, all income statements are going to start with our sales. We subtract our variable operating expenses to get our contribution margin, and then our fixed operating expenses to get our operating income or loss. And so let's go to Media Networks. Media Networks percentage of variable operating expenses is 75%. So if we know their total operating expenses are $19,200 for Media Networks, 75% of that is going to be variable. I'm going to pull my revenues from right here, 28,383. I'm sorry, 28,393 is their sales in millions. Of their operating expenses, 75% are variable. So 19,200 is their total operating expenses, and 75% of that is variable, or 14,400. Can subtract that to get our contribution margin. Okay. And for the fixed operating expenses, you can do one of two things. We know the total is 19,200 and 14,400 is the variable part. So we can simply subtract to find how much is left. Or you could say, well, if 75% is variable, 25% is fixed. What is 25% of 19,200? I think the subtracting is easier than the multiplying. And so that's the approach that I used. Okay. And then subtract to get our operating income or loss. And this is where they tell you it is important, if it's a loss, to put in the negative sign. And finally, compute the contribution margin ratio for each segment. And so we have our contribution margin for Media Networks, 13,993. Divide that by the sales and round to the nearest 1/10 of a percent. So I got 49.28. We'll round that to 49.3. And I'm going to go ahead and click check my work. So you can see all of those answers got the green check mark. So I think you can go ahead and fill in, with the same approach, fill in the other 3 columns, and then you should be able to answer these questions. As always, if you do have any questions about anything, please let me know. Send me an email, ask for a Zoom meeting, and I will be happy to accommodate that. Otherwise, thank you for being here for our review session for exam number 2. Don't forget to open your ebook before you start the exam. Good luck on the exam and let me know if I can help in any way.